Good evening, everyone. Welcome to the March 5th trading session. Today, we'll continue reviewing the strategies we discussed earlier and share our updated view on the market going forward. Overall, Bitcoin rebounded today alongside the rally in US software stocks. That move pulled the rest of the crypto market higher as well. Almost 90% of altcoins followed the bounce. But after the rebound, we're already starting to see signs of a pullback. I've mentioned this strategy before, and at this stage, the message can be summarized in 4 words. Short the rallies. Short the rallies, don't chase longs. So the question now is, does that strategy change? My answer is no for now. The bearish view remains unchanged. Why? Because at this point, Bitcoin has essentially become a capital misallocation trade within the broader market. I've talked about this multiple times. If you look closely, Bitcoin's correlation with the major US stock indices is actually not that strong right now, but its correlation with software stock ETFs is extremely high. In fact, whenever software stocks stabilize or bottom out, Bitcoin tends to stop falling. And when software ETFs rally, Bitcoin rallies as well. You can easily verify this by looking at the US ETF iShares Expanded Tech Software Sector ETF IGV. Why does this happen? Because the investor profiles behind these two markets are very similar. Think about it. What type of investor buys extremely aggressive, high-risk assets? In the US market, there's even a category on the Bloomberg terminal called Halo stocks, which represents a basket of the highest risk tolerance equities. Their price movements also show a noticeable correlation with Bitcoin. So, does this rebound make sense? To some extent, yes. But the underlying reason is not necessarily healthy. Right now, the global market is dealing with geopolitical tensions and capital simply doesn't know where to go. At the same time, investors are worried that AI spending may be too high, that AI companies might have unsustainably high margins, or that valuations have already priced in all the good news. On the other hand, traditional software companies were heavily sold off earlier because many people believed AI would disrupt or replace them, so those stocks dropped sharply. Now, capital is starting to rotate back into that space for short-term allocation. But the key point is this: the investors doing this are mostly bottom fishers with high risk appetite. Their mindset is the same, trying to catch rebounds, and that's exactly why the situation is very dangerous. If the investors allocating to Bitcoin and the investors allocating to software ETFs are essentially the same group of people, then one important question emerges. When a real market shock hits some kind of major event, which asset will they sell first? The answer is obvious. They will sell the asset that doesn't generate interest, doesn't produce cash flow, and doesn't raise rates. That asset is Bitcoin. So the investor profile here is very clear. Another key factor is the behavior of the native Bitcoin investors, those who entered very early before 2018 or before 2020. Many of them are still holding their coins, but they're not injecting new capital into the market anymore. That group is large, but they're no longer providing fresh liquidity. Meanwhile, the new investors entering the market often don't even fully understand what Bitcoin is. Is it a safe haven asset or a risk asset? Does it actually have intrinsic value or is it purely speculative? Many people in the market simply don't know. They're just allocating to it as part of a portfolio, mostly through ETFs. Many of them entered through products listed by Chicago Board Options Exchange, so these investors often haven't studied Bitcoin's underlying value at all. Now imagine a scenario where a major shock hits the market. For example, if a company like Anthropic suddenly launches a new AI product that significantly disrupts the software industry, something similar to OpenClaw or Claudework or other powerful AI agents capable of replacing many traditional software functions. So in that situation, which asset gets sold first? The one that gets mispriced and abandoned first will almost certainly be Bitcoin, not software stocks. Software stocks might be reconsidered, analyzed again, and maybe sold later, but Bitcoin will likely be the first asset investors dump. That's the core logic behind the strategy. And today I just wanted to walk through it once more. Based on this logic, let's talk about whether the current rebound can continue. My answer is yes, it could continue. But the real question is, continue toward where? Let me show you something. Look at this chart. Does this look familiar? Does it remind you of something? Let's go back to 2022. During 2022, the market was also in the middle phase of a bear market. The fear index was extremely high, liquidity in the market was drying up, and capital was scarce. At that time, the market formed a platform consolidation. And within that platform, there were two rebounds. Now, the duration and magnitude back then may not have been as large as what we're seeing today, but the structure was very similar. A consolidation platform followed by a rebound. Many people thought the market had bottomed, but it hadn't. The market continued downward afterward. Now, here's the key point. From that moment onward, from that platform until much later, there was a long period, starting from that platform and extending all the way down to here. This entire stretch is what we call the real accumulation and distribution cycle, or in trading terms, the true chip exchange period. Let me draw a box here to highlight it. From the platform, the market dropped further. Then starting from this point, we entered a very long time window. Don't focus on the price range, focus on the time axis. That long stretch of time is when the real ownership transfer of market positions happened. And that period is actually the golden window for building long-term positions. But this cycle is very long and very exhausting. It grinds people down psychologically. During that time, you may lose patience. You may lose confidence. Your personal financial pressure may even increase, but the people who hold on until the end of that cycle are the ones who ultimately benefit. Look at what happened afterward. From around $17,000, the market eventually moved up to around $70,000. How long did that take? That move lasted all the way into 2024. That's roughly a 7x return, and that's just spot trading, no leverage. If you had used leverage, the returns would have been much larger. But even with spot alone, you were looking at about 7 times your capital. If we measure all the way to the bull market peak this year around $120,000, the return becomes even larger, roughly between 8x and 10x, about 9x overall. Now let's zoom in again. Instead of measuring to the absolute top, let's just measure to a secondary high. And let's assume your average cost basis is somewhere around the middle of the accumulation zone, not the perfect bottom. Even with that conservative assumption, the returns are still enormous. Remember what we just discussed. The key is building positions during that accumulation cycle. And now ask yourself this question. Are we currently experiencing a similar platform structure? Look at the current chart carefully. Doesn't it look similar? First a drop, then a rebound, then another drop, and then we enter a small consolidation platform. This small platform may not look impressive, but in reality, it often represents the final burial phase of the market. Why do we call it the burial phase? Because during this stage, many people start bottom fishing, but the market still has a large amount of trapped supply overhead. All the investors who bought at higher prices create selling pressure that crushes the new buyers. So the last wave of buyers gets buried here. At the same time, market liquidity is already limited. The only people still buying are those with very high risk tolerance, often the same investors allocating into US stock ETFs and other aggressive assets. They come in, buy the dip, and get trapped in this range. Then two things usually happen. Some of them simply hold and forget about it. They leave the position untouched, and eventually, years later, that position becomes extremely profitable. Others do the opposite. When the market drops further, they panic and cut their losses. Some of them capitulate during the next big drop. Now look again at the current market. Doesn't it resemble the same pattern? First a decline, then a rebound, then another decline, followed by a small consolidation platform. That structure often represents the final burial stage. And remember something important. In financial markets, nothing is truly new. Every bull and bear cycle repeats the same patterns. These cycles are as old as mountains. There is no mystery, it's simply how markets work. Now let's look at the previous major cycle. Technically, this is the cycle before the last one, but from a macro perspective, I've always had a framework. Bitcoin has really gone through only 3 major bull markets. That earlier cycle we're looking at was the second bull market. What we're experiencing now is the third cycle, the third bull-bear transition. Look at the structure again. First, a decline, then a rebound, then another decline. After that, a small consolidation platform. And what comes next? A long period of position rotation, what we call the chip exchange phase. This phase is very long. In the previous cycle, that period lasted from around June 2022 all the way to January 2023. That's more than 6 months, almost 7 months of sideways grinding. So think about what it means if you open long positions right now. It could mean you get stuck in the market for 7 months. And that's actually the optimistic scenario, because if the previous bull cycle lasted longer, then logically the bear market consolidation phase could also last longer this time. Once you visualize it like this, the strategy becomes very clear. Right now, this is not the time to go long. The correct approach in the current environment is trade the range inside the consolidation zone, but on the larger time frame, the bias should remain short. That's the strategy that makes the most sense at this stage. Since I didn't post an update yesterday, today's video is mainly a review of the broader strategy. As for the specific short selling strategy, I've mentioned it before. Short the rallies. Whenever the market pushes higher, that's where the opportunities are. But can we short right now? My suggestion is to wait and observe for the next couple of days. This rebound may not be finished yet. In my view, there's still a decent chance the rally continues a bit further. So whether it's Bitcoin or Ethereum, it's better to stay on the sidelines for the next 2 days. But one thing is important: don't go long. Even if the rebound hasn't finished, that's only a probability, not a confirmed signal. There's still a smaller chance that the rebound has already ended. Since the signal isn't clear enough yet, the best move is simply to wait. Take a couple of days to observe the market. If a strong setup appears, I'll definitely share it. If you followed this channel for a while, you already know how we operate. When I give a trading signal, it's because I personally believe there's at least a 70-80% probability behind that setup. Right now, the rebound might still have room to continue, so patience is key. Today's discussion focused mainly on the larger market cycle analysis so that everyone has a clearer framework in mind. That's it for today's update. We'll continue the market discussion in tomorrow's session. See you next time!